Hey everyone, I want to talk about high yield dividend stocks in the video today. I received a question over on Patreon from Jonathon, and he was asking me hypothetically, Ian, how would you go about achieving 10 or even 15% annualized dividend yields, and how would you go about doing that in 2022 if you wanted your income coming in on a monthly basis to pay the bills? And so I have quite a few thoughts around high yield and 10% yields, 15% yields that I want to share in the video today. I am broadcasting here from the Westin Nanea Resort. I am on Anapali Beach in beautiful Maui, Hawaii, here at the Westin Nanea. And so you'll probably see some activity behind me here. This is our room on the ground floor facing the pool right behind me. I really like this room because we can get to the pool so easily. We're having a fun vacation here, much needed, great relaxation here after a really crazy year and a lot going on this year, and so well overdue vacation. But of course, I am not going to forget my dividend stock investing. So I have a lot of content to share with all of you today. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, so make sure to check out the pinned comment below. Jonathon asked the question over on Patreon. I have a lot of amazing content over on Patreon. I just uploaded another net new Patreon exclusive video for my corner patrons. Again, check out the pinned comment to learn about all the cool content I have over there. And also, before I go on further today, I want to give a shout out. I want to say, hey, Donald, it was awesome meeting you here in Maui, Hawaii. Just the other day, I have a fun story. I was at Whalers Village shopping mall with my family here on the Anapali Beach, and we were enjoying some shopping. And all of a sudden, I heard my name. Someone was calling out my name, and I'm like, hey, yeah, that's me. And it was Donald. He is another dividend stock investor who is visiting Maui, Hawaii right now. And it was so much fun catching up with Donald. We actually scheduled a coffee the next day at Starbucks. We met at Starbucks over my second largest dividend stock that I own, over at the Westin Hotel right next to Whalers Village. They recently renovated that hotel. For those of you on the island, they've got a great Starbucks location at the pool level with lots of seating outside, not too far from the beautiful, incomparable Anapali Beach. And so Donald and I sat down the very next day. We had the first ever PPC Ian dividend stock investing meetup here in Maui, Hawaii, and we covered a lot of territory. Donald, it was so much fun getting to know you and talking about dividend stocks, personal finance, life, and so much more. Can't wait to do it again, my friend. Thank you for all of the support here on my channel. So without further ado, as it pertains to high yield, I want to cover a few different topics today. And so I was thinking about 10 or 15% yields 2022, and my first gut instinct when Jonathon asked this question is, you know what? It's not doable. Sorry, this is just too risky, too high of yields. But I started kind of going down a path to really think through his question and come up with at least some general directional kind of points of reference, like what would I do if I needed 10% yield all of a sudden? What would I do if I needed 15%? So hypothetically speaking, of course, I am just sharing my personal journey here, just sharing this for informational purposes, kind of food for thought, if you will. The first thing I thought of were sin stocks, and in particular, I thought of sin stocks that are US focused, and I thought primarily of Altria, because Altria is under a lot of heat and they offer a nice starting dividend yield with dividend growth as well. So as you can see on the screen in front of you right now, the first thing I want to share with you is just Altria. And so Altria is trading at $44.10 a share, and based on the EPS estimates, the PE ratio forward is at a 9 this year, 8.68 next year. Now what's so exciting is the starting dividend yield is 8.2%, but we know because the payout ratio is 74% and their stated goal of a payout ratio is about 80%, that the next increase is probably going to be about 8%, and it's going to bring that payout ratio to 80%. And so that's something I think will be announced any day now. I'm really excited about that. Hopefully they do that. We'll see. There's a lot of troubles over there as well, a lot of risk. I'll get to that in a minute. Primarily, the FDA is really challenging the JUUL brand of products that company owns. And that was probably one of the worst acquisitions I've seen of all time. It brought them nothing but trouble. But if any company can weather a bad acquisition or a storm, boy, it sure has proven to be Altria. So the market capitalization of this company is $79 billion, and the 5-year compound annual growth rate over at Altria, on average, they've increased the dividend by 8.1% per year on average. And so off the bat, this doesn't get Jonathon kind of what he was looking for, but as far as dividend stocks go that can actually kind of cover their dividend, that have, look, this is one of the riskier positions in my portfolio, but I was just thinking, out of all the stocks I owned, like what could even get me in the ballpark of the kind of high yields that Jonathon was looking for? Well, maybe something like Altria would, but of course, no one's going to construct a portfolio, or I shouldn't say no one, but very few people are going to construct a portfolio of a single stock. It's just too risky. And so the challenge here is, sure, Altria could help an investor get to kind of that 10% yield on cost pretty quickly, maybe up to 15% even for the investor who's willing to wait a few years. But of course, it carries a ton of risk. And I'll get into some of those risks in a minute. But I ran a little model that I want to share with you. And Jonathon, I hope this is helpful as well. Check it out on the screen right now. And so the model that I want to share with all of you is just, hey, what's going to happen if the dividend growth slows a little bit down to 6%? I think it will slow. But let's say the next increase is going to get us an 8% increase, just because they have a stated goal of an 80% payout ratio, and they're below that, and the math just shows me to get to 80%, they need to increase at 8%. So I'm just looking years 1 through 10, and I'm looking, this is an investor, a hypothetical situation here where dividends are not reinvested. This investor is using the dividends to pay for living expenses. And so anyway, what's going to happen? Well, year 1, we know we have a larger increase, and so it gets the yield on cost up to about 8.8%. But year 2, I have a slower dividend increase of 6%. For year 2, the dividend will get up to a 9.3% yield on cost, so on and so forth. You can kind of see what's going on here. Basically, to get to that 10% that Jonathon was looking at, or at least 9.9, we can round it up, it's going to come in year 3. And really, to get up to that 15%, it's going to come in year 10. And so the fact of the matter is, the only stock that I can think of that someone possibly could get to 10% yield on cost pretty quickly would be Altria, and to get to 15, it would take some time, but it would happen with yield on cost, and it would happen even quicker with dividends reinvested. But again, this hypothetical scenario is for someone who is looking to retire and live off of the cash flow right away. Now, the challenge is those dividends don't come in monthly, they come in quarterly, but the investor could take those quarterly dividends and partition them out so that the cash is used on a monthly basis for living expenses. Now, I was thinking, in addition to Altria, I ought to look at BTI, so check it out on the screen right now. This is a UK-based company, but they have a large US-based business, largely with their acquisitions of Reynolds and Lorillard. And so with BTI in particular, they are yielding 7.5%. PE is a little higher, but I think there's probably some, and payout ratio is higher, but there's probably some GAAP versus adjusted accounting issues here. I just have to look into it further. I did a 4-year compound annual growth rate on the dividend for this one instead of 5-year, because 5 years ago they were transitioning from the payout schedule being twice per year to 4 times per year. Anyway, if I look at a 4-year, they're only growing the dividend on average by 1.7%, and the starting yield is only 7.5% only. It's a huge starting yield, but I'm just saying, for someone looking for a really high starting yield in the 10 or 15% range, BTI, quite frankly, just doesn't get you there. But maybe it has a little less risk than Altria, because one, their comparable products to Altria's JUUL don't seem to be under quite as much scrutiny as JUUL. And also, quite frankly, they have a heated product. IQOS, Altria is having some troubles with that and possible alleged patent infringement, whereas BTI does not appear to have those same issues at this particular time. And so it seems in the US market at least that BTI, it's probably a lower risk play, and that makes sense. That's why the PE ratio is a little bit higher, dividend starting yield is a little bit lower. But again, is BTI in the short term ever going to get to that 10 or 15% starting yield for an investor looking for that? Probably not. And this kind of proves my point. I think one of the important things is for an investor looking for these high starting yields, when you just look at kind of the risks, one of the riskiest places in my entire portfolio, my dividend stock portfolio, it doesn't even get quite there. Now, we could see a massive market correction, and maybe these stocks could get there on a starting basis if just the floor falls out and the market just tanks. But even with all the troubles in 2022, I look at BTI, it's been trending up in share price, and Altria is down, but it didn't look like too much over the last year. Now, I want to share a few insights. Check it out on the screen right now. These are some of the risks with these particular types of investments. Of course, anyone looking for stable cash flow, monthly cash flow to live on, and would be looking to add these types of stocks to a portfolio, boy, it's worth considering the risk, because the FDA is trying to ban sales of JUUL in the US. I didn't even write it here, but IQOS is under some pressure. There's been declining demand in these products since the 1970s for the traditional product. It's not socially acceptable anymore. And there are some pros, though. There was a master settlement agreement that's behind us, well behind us, and thankfully that was agreed upon before kind of this new era of radical politics. So I think that's a good thing for this industry. I would say there's few or no new entrants, competitors, that kind of thing. And so anyway, that was where my mind went first. But where my mind went second was basically to covered call ETFs. Now, a lot of you know I actually sold my position in XYLD. The reason that I sold it is the underlying equity price. It fell a lot further than I thought it would in the market correction. And so I don't want to hold something that's spinning off a lot of cash flow, but the underlying share price can't at least hold up. But basically what covered call ETFs do is they purchase an index or they purchase a basket of stocks, they write covered calls against those stocks, and they generate cash flow. And a lot of these have been underperformers in the bear market. But when our market rebounds, who knows? They might be overperformers. We shall see. But as you can see on the screen in front of you right now, I want to share two of them. The first one is XYLD. This is the one that I owned that I sold. Right now, XYLD is trading at $43.98 per share, and that, based on the trailing 12-month distributions that I have there on the right-hand side of the screen, they have a starting yield of 12%. Not bad, but it's a little worse when you consider that 1 year ago the share price was 49 and that the equity value is down 11% in a year. And so you're getting 12% of distributions, and these aren't qualified dividends, mind you, these are taxed at a higher rate. You're getting 12%, which falls within the basket that Jonathon was looking for, but unfortunately the underlying equity is simply evaporating. Now, of course, that equity could come back over time, but I've seen a lot of my dividend stocks, even Altria, performing just fine, even though Altria is down a little bit. I mean, I have dividend stocks that are up. They're doing really well. And so the fact of the matter is, for me, for my personal situation with a really long-term time horizon, I'd rather have companies, positions in my portfolio that are spinning off cash flow, that are increasing the dividend, where I can get a high yield on cost, but where the underlying equity is not only maintaining its value over long-term periods of time, but is increasing the value, and hopefully increasing the value pretty substantially. But one thing worth pointing out, and by the way, if you enjoy the video so far, please go ahead and smash that like button. It means the world to me. And please head on to the comments below. I had a comment once when I was sharing my thoughts on XYLD and how I was disappointed with it eroding in value. And that commentator said, well, hey, for a older person, for a retirement age person, maybe it's okay because you can look at it more like an annuity. And I thought that was interesting. And so I think for someone who is comfortable with an annuity, which is basically a financial product that is sold typically by a life insurance company. What happens is when you annuitize it, it will pay out monthly income for the rest of your life and sometimes the rest of your spouse's life as well. But when both pass, no more monthly income, it's gone. The way an annuity works is the life insurance company will invest, and there's going to be some component of fixed income there, probably invest in very low risk assets, but also they take portions of the underlying capital and just distribute it out to you. And obviously when you pass, they probably run some kind of scenario where there's something left, and so that's how the life insurance company makes money or has money left for all of the underwriting and risk management that they take on. But anyway, you could look at XYLD like an annuity. Well, hey, the underlying thing is losing value, but who knows, for someone that's a lot later in life, it may still make sense because that yield is so high and they're comfortable losing all of the underlying equity because by the time they pass, they're not part of their strategy. It's not really leaving a nest egg for the future. If someone falls into that bucket, these types of products, hey, maybe they do make sense. And with that, as you can see on the screen right now, the counterpart to XYLD is the S&P 500 one. QYLD is the NASDAQ covered call ETF. This one, honestly, is down 18% in the last year in terms of its equity, but it's yielding on a 12-month distribution analysis on the current share price 14%. So it's actually lost more equity than it's even paying out. And again, those yields are taxed, and it's not ordinary, or it's not qualified dividends. And so that's something to keep in mind as well. But again, this is where my mind started going. Jonathan was asking a question. My mind first went to, hey, you can't do this at all, to well, hey, maybe with some sin stocks could get there, but no one really would ever make a portfolio all sin stocks, although that's what I did when I was really young and I was just starting out with dividends, but I was really young and taking on a lot of risk. At my age now, I wouldn't do that, and I'm in my 40s. The next thing my mind went to is these covered call ETFs, because again, they don't make sense for me. I've tested it all, everyone. I share all of my triumphs, all my successes here on YouTube, but all of my mistakes as well. You can see them in real time. I share my journey, my whole journey, all the good and bad. And for me, at least, I was dabbling in the covered call ETFs. I learned something in this recent market downturn, and I learned that they are not for me, but I also learned that these are financial products that could make sense for certain niche cases, and so I wanted to point those out in the video today. So next, my mind started going, well, boy, if it's, someone looking to live off of dividends and needs 10% right now or 15% right now, you can't just do that with sin stocks. You can't just do that with covered call ETFs. What other alternatives even are there? And so I thought of a few, as you can see on the screen right now. What I wanted to share was just real estate syndications. The problem with real estate syndications, though, these are kind of private opportunities, typically for accredited investors, and so that means you have to have a certain net worth or a certain amount of income coming in. But the problem with real estate syndications is they're illiquid. We're at the top of the real estate market, the absolute top. Typically, based on some of the research I was doing online, I just went to a real website that I like, Realty Mogul. I've never invested there, but I think they have a really cool business model. Their deals are only doing like 6 or 7% cash on cash. So 6 or 7% is a lot different than 10 or 15%. And so that probably doesn't work. And the only other alternative I thought of, well, heck, is could an annuity work? But again, I was researching annuities, and annuities typically are doing about 6%. And so you can get monthly cash flow, but if you put in 100,000, that's only doing 6,000, or only. It's good yield, but again, it's 6% per year, and that will erode your principal when either the first or second to pass, depending on how the life insurance policy is written. That annuity, it's gone. All the money's gone. There's nothing to pass on. Again, one of the things I love about this question is this thought exercise gets all of us thinking, boy, dividend stock investing is so powerful, and it's so powerful especially for investors who get started younger because of the concept of yield on cost. And yield on cost, you saw some flavor of that in the Altria example earlier in the video, but true yield on cost is even better when dividends are reinvested. And so this is all a reminder that 10 or 15%, it's possible, but it's not possible for investors who are just, hey, I need it today necessarily. It's kind of possible, but you're stretching and you're you're taking on undue risk to do something like that. But for all of us who have more time, like myself, getting started younger, I'm yielding over 20% yield on cost on my original tranches of Altria. And so that's just because I've been in it a long time. And so it goes to show the power of the long-term perspective. But what I also want to share is a conclusion and some food for thought for folks, because I get this question all the time. Jonathan, I'm glad you brought it up, because I get so many people asking, how do I get high yielders? How do I get monthly dividends? And so check it out on the screen right now. Here's kind of a summary of where all of this takes me. And so where it takes me is SIN stocks could help, but they're risky, and they could create a huge concentration of risk if they're over allocated to. Covered call ETFs could help, but it's, in my opinion, an annuity-like strategy. The principal will erode over time, but it could possibly make sense for folks who are older, who are willing to take on risk, because there's a lot of risk with those, in my humble opinion. The other alternatives that I was thinking about, like real estate syndications, annuities, they probably don't work for this particular situation because they're not a high enough yield, but they could be a piece of the puzzle. My conclusion tells me that basically these types of yields that Jonathan was asking about, they're probably not possible in year one, but they could be possible after many years due to yield on cost. I would say for someone who needs yields right now, I would say it's probably best just to speak with a licensed financial advisor. And the only solution at this point that I can really come to terms with is it's going to have to be a solution that's a hybrid. Some of it will be cash flow, dividends. Some of it will be literally eroding principal and taking money out of the pie. That's going to be the only way to get to that 10 or 15% or that higher level of cash flow without taking on undue risk. The only way is going to be selling off pieces of the pie. Otherwise, I believe personally, again, I'm just sharing this for informational purposes, but I believe the risk is just too high. I would say some key pieces of the puzzle are, what are the expected lifespan? How much does the investor want to leave over to the next generation? Maybe that investor doesn't want to leave anything, and then that investor speaks with a financial advisor and understands, hey, if I'm going to live another 20 years, I'm comfortable. I'm comfortable selling off some of the principal to fund living expenses, and that can be structured in a way where a financial advisor helps. It could be structured in a way where a life insurance agent with an annuity type product or annuity could help. And so those are some pieces of the puzzle. I would say just a key takeaway that I personally think of all the time for dividend stock investors, this is taking a step back, is having a contingency plan. We are mostly here on this channel, from what I've heard from folks in the comments below, investing for the long term with the goal of having complete financial freedom, full fire. I'm trying to live a fat fire so I can be in Maui like this all the time. I'm at that point in my life where, boy, it would be nice to travel a lot more than we already are. But what happens is when reality strikes, we all learn that with inflation, the amount of dividend income that we all need to live is a lot. And it takes a huge nest egg, and that nest egg is going to likely be there for investors who have a lot of time, a lot of reinvestment on their hands. But there's always this thought, and I think about it sometimes, what if I kind of get to that age where it's like, I don't want to work anymore, or I want to work, but I'm just gonna do it on my terms, and it's gonna be a lot less income. But what if at the same time my dividends at that time aren't quite where I need them to be to live fat fire? Well, I have a contingency plan. One of the things that I've invested in that some of you know about, I'll share a link in the pinned comment below, is I have a bond portfolio. When those bonds mature, I'm okay just kind of using the principal for living expenses and partitioning it out. It's a contingency plan, so I can kind of, if the ends don't meet, I have a stopgap. I have extra principle that I'm just happy to use in retirement to pay for stuff. And so I've shared some other insights on this topic over the years on Patreon. I have a lot of videos over there. I think the last one I uploaded was video 64. And so Anyway, another good stopgap measure could just be a 401k, for example, or a retirement account. So many dividend stock investors have both dividend stocks, individual accounts, but also retirement accounts. And when retirement comes, if the dividends don't quite fund everything, and maybe the investor wants a fat fire in Maui, for example, some of those funds or all of those funds could be used from the retirement account just to use them. Just the principal, not only the interest or the dividend, the cash flow, but the principal itself. And so that's a topic a lot of us don't talk about as much in the community, because I think we're also laser focused on the real goal, which is complete fire. But I think being practical in 2022, that is something that probably ought to be thought of. Now, in general, those stopgaps are more for later in life. At least that's how I look at it. It's not for using in my 40s, 50s, but it's more like 60s, 70s, 80s. That's where those types of stopgap measures come into place for extra expenses, extra splurges, extra vacations. I love you all. Thank you for watching the video today, everyone. Please go ahead and smash the like button if you enjoyed the video. And don't forget to subscribe, because I do have new videos on the way all the time. And please do smash the like button if you appreciate the extra effort I'm taking here on vacation to share these videos. I love you all. Before I go, in terms of full disclosure, I am long Altria, ticker MO, BTI, ticker BTI. I am long Starbucks, ticker SBUX. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first before making any decisions. It's possible to lose money. There's a lot of risk out there in the financial markets right now in 2022. I love you all. Thank you for watching. I will see you in the next dividend stock investing video.